It's late. The world's quiet again. Screens are dim, markets are closed, and the storm that rattled the trading day has finally started to fade. Welcome to Midnight Market, a moment to pause and think, to understand what's really happening beneath the headlines. Tonight, we're slowing things down and talking about something that quietly powers much of modern investing, the ETF, and the index that sits at the heart of it all, the S&P 500. An ETF, or exchange-traded fund, sounds technical, but the idea is beautifully simple. It's a basket of investments, one share that holds tiny pieces of many different companies. Buy one ETF, and you instantly own a slice of hundreds of businesses. It's diversification without the stress of stock picking. That idea, created in the early 1990s, changed everything. Gave ordinary people the same access to markets that big institutions had, and it made building wealth more about patience than prediction. Before we go further, let's slow down for a second. We keep saying S&P 500, but what does that actually mean? The S&P stands for Standard & Poor's, a financial firm that's been analyzing companies for over a century. They created something called the S&P 500 Index, a list of the 500 largest publicly traded companies in the United States. Think of it like taking the pulse of the US economy. When those 500 companies are growing, hiring, and innovating, the index rises. When they struggle, it falls. And the 500? That's literal. It's the number of companies included: Apple, Microsoft, JP Morgan, Coca-Cola, Walmart, ExxonMobil, all inside the same basket. So when people on the news say, the market was up 1% today, they're usually talking about this index, the S&P 500, the ultimate benchmark for how corporate America is doing. Now, here's where SPI comes in. You can't actually buy an index. It's just a list on paper. But you can buy something that tracks it. That's what SPDR S&P 500, ticker symbol SPY, does. SPY is an ETF built to mirror the S&P 500. When you buy one share of SPY, you're effectively buying tiny pieces of every company in that index. If Apple, Microsoft, or Coca-Cola move, your SPY share moves too. So, the S&P 500 is the index, the measurement. SPY is the fund, the way you actually invest in that measurement. It's a simple bridge between an idea and ownership. SPY's mission is straightforward. Track the S&P 500 as closely as possible. When the index rises, SPY rises. When it falls, SPY falls. No secret formula, no hidden trick, just math. And over time, that math has been rewarding. $10,000 invested 10 years ago has grown into more than $40,000 today, even with all the market chaos in between. It's a quiet reminder that in investing, simple often beats clever. The S&P 500 isn't just numbers scrolling on a screen. It's 500 stories moving together. Tech giants, banks, healthcare innovators, retailers, energy producers. Right now, technology dominates. Apple, Microsoft, Nvidia, Amazon, and Meta make up over a third of the index. Their performance can shift the entire market in a single trading day. When they do well, the whole index glows green. When they stumble, everything feels it. Over the past decade, the S&P 500 has averaged about 15% per year in returns. An incredible run. That's not from magic. It's from time, compounding, and human progress. Through trade wars, pandemics, and inflation spikes, the market kept expanding. Not in a straight line, but steadily upward. That's what long-term investing really is. Enduring short-term chaos for long-term growth. Think back to March 2020. The index fell to about 2,200 points when the world shut down. Panic was everywhere. Fast. Forward to October 2025. It's sitting near 6,700 points, almost a 200% climb from the lows. No one predicted that. But those who stayed invested didn't need to. They just needed patience. From July through September 2025, the market inched higher again, up about 3%. Overall, tech led the way with strong AI-related earnings, from Nvidia and Microsoft. Inflation cooled closer to the Federal Reserve's 2%. Gold energy prices rose modestly as supply tightened. Consumers kept spending. Travel, entertainment, and retail remained surprisingly strong. Small caps lagged as borrowing. Costs stayed high. It wasn't an explosive quarter, but a steady one. The kind of calm growth that long-term investors quietly love. 3 major factors defined that quarter: interest rates. The Fed held steady but hinted at a possible cut in early 2026. Corporate profits. Margins stayed strong around 11%, defying fears of slowdown. AI investment. Companies poured billions into data centers, chips, and automation. The result? A market that's cautious, but confident. Now we're in the final stretch of the year, October through December. Analysts are watching. Earnings season. Can big tech keep justifying its high prices? Rate policy. If inflation keeps falling, the Fed could finally start cutting next year. Politics. Election year uncertainty could add short-term noise. The general outlook is modest optimism, maybe another 4 to 6% gain into year-end, if nothing unexpected hits. But the deeper lesson isn't about the next few months, it's about the next few decades. In a world addicted to speed, ETFs reward patience. Funds like SPY, VOO, and IVV don't try to outsmart the market. They are the market. They rebalance automatically, reinvest dividends, and charge almost nothing in fees. They're built for people who don't want to live inside the news cycle, for those who believe that progress, over time, is profitable. That doesn't mean the S&P 500 is invincible. When a handful of companies control so much of its movement, concentration risk grows. If those giants stumble, the index could slide hard. That's why some investors mix in smaller company ETFs or international funds, not to chase more, but to protect what they have. The hardest part of investing isn't analysis, it's emotion. Markets rise, fall, and test your patience. But every generation learns the same lesson. The people who stay in tend to win. Since 1950, there hasn't been a single 20-year period where the S&P 500 produced a negative return. That's the power of time and trust. ETFs are the practical expression of that trust. They make doing the right thing the easy thing. Buy, hold, let it work. They're not built for excitement. They're built for endurance, not for headlines, but for outcomes. They're not get-rich-quick tools. They're get-rich-eventually plans. So tonight, as the markets rest and the city hums, remember this: the S&P 500 is more than a number. It's a snapshot of human effort, and Enterprise, the ETF, is how you quietly take part in it. And patience remains the most underrated investment skill of all. No hype, no urgency, just perspective, one calm evening at a time. Thanks for listening to Midnight Market. I'm your name. Stay thoughtful, stay steady, and let time do the compounding.